Welcome to Headline Roundup. Today is August 8, 2022. We are recorded today. We will be back again live August 15. Let's get right to it. Headlines this week: the Inflation Reduction Act is anything but. Mary Daly demonstrates more Fed arrogance. And Matthew Piepenburg wrote a piece confirming what I have long held to be the case, and that is recession is here. And we have more signs that housing is weakening. So let's get right to it. Ron Paul, a former guest on my radio program, wrote this piece on Monday, August 1, about the Inflation Reduction Act. He calls it another DC lie. I would agree. He said the Affordable Care Act, the No Child Left Behind, and the USA Patriot Act all received new competition for the title of most inappropriately named bill when Senate Democrats unveiled the Inflation Reduction Act. This bill will not only increase inflation, it will also increase government spending and taxes. Paul goes on to explain that inflation is the act of money creation by the Federal Reserve. High prices are one adverse effect of inflation, along with bubbles and the bursting of bubbles. One reason the Federal Reserve increases the money supply is to keep interest rates low, thus enabling the federal government to run large deficits without incurring unmanageable interest payments. This so-called Inflation Reduction Act actually increases government spending. That alone tells you that it will increase inflation, since China and Japan are no longer lining up to buy U.S. debt, and the Fed is the purchaser of last resort. In order for the Fed to purchase U.S. government debt, they have to create currency. That really is all you need to know. Paul goes on to explain that the bill authorizes spending hundreds of billions of dollars on energy and fighting climate change. Much of this is subsidies for renewable energy, in other words, green corporate welfare. Government programs subsidizing certain industries take resources out of the hands of investors and entrepreneurs who allocate resources in accordance with the wants and needs of consumers and give the resources to government, where resources are allocated according to the agendas of politicians and bureaucrats. When government takes resources out of the market, it also disrupts the price system through which entrepreneurs, investors, workers, and consumers discover the true value of goods and services. Thus, green energy programs will lead to increased cronyism and increased waste. The bill also extends the temporary increase in Obamacare subsidies passed as part of COVID relief. This will further increase healthcare prices. Increasing prices, Paul correctly points out, is a strange way to eliminate price inflation. The only way to decrease healthcare costs without diminishing healthcare quality is by putting patients back in charge of the healthcare dollar. The bill's authors claim the legislation fights inflation by reducing the deficit via tax increases on the rich and a new 15% minimum corporate tax. Tax increases won't reduce the deficit if, as is going to be the case, Congress continues increased spending. In fact, what you'll notice in some information I'm going to share with you here momentarily is that year over year, tax receipts are down. So in an environment where the economy is moving into recession and tax receipts are down year over year, we now see Congress moving to increase taxes. This will end poorly. This will end badly. Increasing taxes on the rich, Paul writes, and corporations also reduces investments, slowing the economy and thus increasing demand for government programs. This leads to increasing government spending and debt. And while there is never a good time to raise taxes, the absolute worst time for tax increases is when, as is the case today, the economy is both suffering from price inflation and is in a recession. The bill also spends $80 billion on the Internal Revenue Service. This will supposedly help collect more revenue from rich tax cheats. While supporters of increasing the IRS's ability to harass taxpayers claim their target is the rich, these new powers will actually be used against middle-class taxpayers and small businesses that cannot afford legions of tax accountants and attorneys and thus are likely to simply pay the agency whatever it demands. Increasing spending and taxes will increase the pressure on the Federal Reserve to keep interest rates low, thus increasing inflation. I've said this for a very long time. Paul puts it very succinctly here. If Congress was serious about ending inflation, it would cut spending. It would start with overseas militarism and corporate welfare. A Congress that took inflation seriously would also take the first step toward restoring a free market monetary system by passing Audit the Fed and legalizing competition in currency. Speaking of the Fed, a member of the Federal Reserve Board, Mary Daly, caught some slack this past week, saying that she doesn't feel the pain of inflation. This is a quote from the president of the San Francisco Federal Reserve Bank, Mary Daly. She says, quote, "I don't find myself in a space where I have to make trade-offs because I have enough, and many Americans have enough." Now, Daly said and counted herself among the many Americans who are actually not being bothered much by inflation because she has enough to deal with it. But she did devote plenty of airtime to discussing how she has seen consumers struggling and her goal to get inflation down to pre-pandemic levels, which somehow got lost in social media discourse. Not surprisingly, everybody kind of advances the agenda that is their own. Daly has supported increasing interest rates in order to lower inflation. The goal, she has stated, and the generally stated goal of the Fed is to get inflation down to the 2% level where it was prior to the pandemic. So Daly said this, I have to say that I don't feel the pain of inflation anymore. I see prices rising, but I have enough that I can make substitutions, that I can do things. So I'm not immune to gas prices rising, food prices rising. Sometimes I balk at the price of things, but I don't find myself in a space where I have to make trade-offs because I have enough and many Americans have enough. Daly then expressed empathy for the Americans who have been struggling under inflation. However, she said, quote, "Those are the people we have to worry about." And that's why she stated she is, quote, "so resolute on getting inflation down." She said, "I recognize what it feels like when you don't have that situation, when you live so close to the edge of your income that rising prices actually force real trade-offs. That is the case for most of America." She added, quote, "So in my daily life, I see the rising prices, but I'm fine because I have sufficient income to make those trade-offs. For other people, that's not the case. And those are the people that lowering inflation is so important for." Now, other portions of the interview with Daly had her saying her goal was to create a sustainable economy for Americans, an economy that gives people, quote, "economic dignity." She described economic dignity as being able to both earn a living and to afford the things that you want. It's not about trying to scrape by to get the things you need, she said. It's about being able to save and having disposable income left over to do what you want to do. Nevertheless, Ms. Daly's quotes rubbed a lot of people the wrong way. She, along with other Fed officials, have said that the bank has to raise interest rates a lot higher and keep them there in order to combat inflation. We will have to see what happens. Now, Matthew Piepenburg, who is one of the analysts that I really enjoy reading, wrote a piece that I want to share a lot of with you. He talks about the fact that we are in recession. That was confirmed with the second consecutive quarter of negative growth, of economic contraction, if you will. Piepenburg says the Fed rose interest rates 75 basis points in what superficially appeared to be a hawkish insult on inflation. But reality was, according to Piepenburg, it was nothing more than another monetary bluff. And I've talked about this in the past, that in order to get inflation under control, in order to subdue inflation, you have to have real positive interest rates, and we are a long way from that. Piepenburg agrees. He said, quote, "As I've consistently argued, the Fed has wanted to exploit inflation as a classic means of secretly inflating away chunks of its embarrassing debt pile while publicly pretending to combat inflation with anemic rate hikes, which never catch up with current inflation rates." So again, he stated it a different way, but he is saying, as I have, that you have to have real positive interest rates in order to get inflation under control. Everyone, Piepenburg says, including Powell, knows that Uncle Sam cannot afford rising interest rates or a perpetually strong U.S. dollar. So why the public ruse to fight 9% inflation with a 2.5% federal funds rate? It can't be done. Piepenburg says, here's what they're doing. The Fed sees a recession coming, and they need to raise rates today so they have something, anything to cut tomorrow. I believe that. I think that makes sense. Thus, and as consistently argued, the Fed's hawkish July chest puffing will eventually lead to some dovish two-stepping, as Powell has effectively telegraphed a future rate hike pause by using the magic words depending on the data. I have said that I believe the Fed will reverse course as well, perhaps as early as later this year, but I would certainly expect it by the first half of next year. Piepenburg says, in short, I believe the Fed is looking for an excuse to print more dollars and to cap more yields and rates with more inflationary mouse click magic money, and hence more Main Street pain. All this is very bad for a debased yet relatively strong U.S. dollar, and all very good for real monetary metals like gold. Stated simply, Piepenburg says, I feel last Wednesday was the first sign or hint of an inevitable Fed pivot from rising rates to pausing rates, and then eventually falling rates and a falling dollar over the coming months and quarters. I could not agree more. We'll know more at the end of August when Powell scoots off to Jackson Hole as the rest of the U.S. sinks deeper into a recessionary hole. Piepenburg then asked, what will be the new excuse for the Fed to switch from being tough on inflation to be more accommodating? Powell described it using Fed speak as, quote, watching for a slowdown in economic activity. Piepenburg says if you translate that Fed speak into honest speak, it just means that Powell's narrative will be shifting from inflation semantics to recession realities, despite every current effort made from DC to deny a recession. Piepenburg says, I'm always impressed by the Fed's ability to pervert English math and honesty in the name of fantasy calm and policy. As we've shown elsewhere with blunt math rather than sensational drama, the Fed and its minions at the Bureau of Labor Statistics have literally invented a magic calculator which makes 2 + 2 = 1 on everything from CPI inflation and M3 money supply to the current metrics used to privately sought negative interest rates into publicly positive real rates. With so much dishonesty from the policymakers, it comes as no surprise that now even the definition of a recession is being perverted, is being convoluted to supplant reality with fantasy and to keep the masses comfortably numb from the consequences of the Fed's increasingly failed monetary policies, namely a Fed-engineered recession to deflate Fed-made inflation. But can any of us remember the last time a central banker stood up and confessed, boy, we really screwed that up. We got that wrong. Now we have to put up with years of self-inflicted misery. Gosh, we're sorry we did that. That has never happened. Piepenburg says, can you imagine a central banker saying, okay, We've been lying to you for years about true inflation levels, which we actually need to pay down the debts we've helped create and which we will now use a recession to quell. Sorry about that. No, you won't hear that from central bankers. 2 consecutive quarters of declining real GDP is how recessions have always been defined. And this is not a new phenomenon. Like I say, recessions have been defined this way for decades. Powell, Yellen, and Biden's press secretary, however, will say that the real definition isn't as simple as that. You have to look at more things. We've all heard it. But Piepenburg points out some facts. Here is where the economy is presently. Number one, U.S. new home inventories are at the highest level since 2018. Pending home sales fell year over year 20% in June. As I've been predicting, the housing market, I believe, will follow the stock market down. And I believe that housing is starting to take that track and take that path. Housing data is directly linked to tax receipt data. That is, both fall together. And right now you see that tax receipts are down year over year, as are stocks. And now we have the Inflation Reduction Act in name only. It's an Inflation Reduction Act that will increase taxes. Again, this will just exacerbate where we're headed. Advertising budgets and spending policies are falling at places like Amazon, while inventories at places like Walmart are rising as their profits are falling, including names like Target, whose stock price tanked 24% on first quarter earnings misses or misfires, as Piepenburg says. 4, hawkish rates and a strengthening U.S. dollar are poison to the earnings flows of such enterprises already in debt up to their ears after years of free debt expansion in the backdrop of repressed rates. By the way, such ad spend cuts, falling earnings, tanking profits, and new hire slowdowns seen across the U.S. at retailers like Walmart, Target, and Amazon are typical and leading recessionary indicators, which often precede or portend future labor layoffs. 5, consumer confidence, even among high-income Americans, is sinking fast. 6, rising rates and the strong U.S. dollar policy pursued by Yellen and Powell has made the cost of U.S. entitlements like health and Social Security painfully worse and ultimately unsustainable. This statistic that I'm about to share with you is really eye-popping. Piepenburg says when Yellen was drunk driving at the Fed, for example, those entitlements were 54% of U.S. tax receipts in 2015. Today, as spending increases and inflationary 10% cost of living adjustments are honestly applied, annual U.S. entitlement payments will very soon reach 90% of U.S. tax receipts. Entitlement payments will soon reach 90% of tax receipts. That doesn't count interest on the debt. That doesn't count military or other spending. That is unsustainable. In short, the current and hawkish rising rate strong U.S. dollar policy at the Fed building will bankrupt the federal government unless a pivot is made soon to fill the spending gaps and deficits by just creating more currency out of thin air. It's the only way it can be funded, and this will ultimately have to feed this inflation monster. 7, as to Uncle Sam's embarrassing bar tab, he is facing $23 trillion of outstanding IOUs, 30% of which are poised to reprice at the end of this year. All that debt, and most of it is financed short term. It'll have to be refinanced at much higher interest rates. Thus, unless the Fed hits the QE button very soon, Uncle Sam will be hiding from his creditors behind the Fed and is currently dim happy hour sign. 8, at the global level, nearly every major developed economy is little more than a glorified banana republic. Mathematically staring down the barrel of a sovereign debt crisis as governmental rates or costs of borrowing are rising at the same time economies are contracting. And the chart there shows Growth is declining. Export orders are declining. This is the perfect economic storm. And finally, I want to talk a little bit about housing as we come to a close here. And again, we are recorded today. We will be live again next week. The deteriorating situation shows rent growth collapsing in Sunbelt markets. The housing and renting market continues to teeter on the brink, and the newest incoming data doesn't offer up any clear signs of stabilization. In fact, new data suggests exactly the opposite, that volatility in housing could only be beginning, and they're going to have plenty of fodder on deflation, which we have talked about frequently, invoking the effects of a reverse bullwhip on the economy. A new report from apartments.com examining multifamily rent growth trends for July of 2022 shows that the Sunbelt markets are set up for what is being called a significant collapse of demand heading into the back half of 2022. Sunbelt cities, which had previously dominated the top 10 rent growth markets in July, with 8 out of 10 located within the region, are now setting up for the fastest pullback. Palm Beach is singled out as an example. We have talked about Palm Beach rents and real estate on past Headline Roundup webinars. Palm Beach has seen a year-over-year asking rent falling 30.6%. Tampa and Las Vegas have also seen double-digit pullbacks in rent. Jay Liebig, who is the National Director of Multifamily Analytics, the company that owns Apartments.com, had this to say, quote, "Throughout the month of July, while multifamily yearly rents continued to perform well above historical averages, the declaration of rent growth quickened at a time when markets typically post their best results." He continued, quote, "The deteriorating rent situation highlights a significant collapse of demand in the sector when new unit deliveries are projected to hit 230,000. So again, these things cycle. They have overbuilt, expect big pullbacks in rent. The overall rental picture is deteriorating according to this release. Analysts have found that looking sequentially, 12 markets saw absolute asking rents decline over the past month. Miami led the charge with average asking rents down $11 during July, in addition to 5 markets that reported no change in rents over the last 30 days. So things are indeed starting to slow down. The stark reversal for Sunbelt markets can now be vividly seen in the month-over-month charts. Markets that saw negative or flat growth in July are dominated by Sunbelt locations, including Fort Lauderdale, Austin, Orlando, Charlotte, and Tampa, among others. That's my headline roundup for this week. Again, we were recorded this week. We will be live again next week on August 15th. If you're not using retirementlifestyleadvocates.com, the podcast version of the radio show is posted there, and all these headline roundup webinars are posted there as well. Thanks for listening. I'll be back again next week.